I'm going to take you into a little shallow pool called fundamental analysis and teach you one simple number that you can use to find the best stocks to buy and also to know which stocks to avoid. Because as we all know, it's the secret sauce for investing. It's not just getting in at the right time or getting out at the right time. It's getting the right stocks that have a reason for going up or going down. And what we've done here at the Millionaire Blueprint and what I'm going to be teaching you today is we've been able to craft down to a single number, one number, a methodology that you can use on your own. You can do this in 60 seconds or less. So I'm going to show you how as we go through this presentation today to know whether you want to buy a stock, hold a stock, or sell a stock. And that one number is it's very easy to use. And I'm having you're going to have to. Hopefully everyone will bear with me. I'm unfortunately traveling, so I'm on a funky Wi-Fi system, so I want to make sure that everything's working okay. So I'm doing that in the background while I go through the presentation, so just bear with me a little bit. But this one number, first of all, it's simple to use. You can do it, as I said, really in 60 seconds or less. If you can add and subtract, you can do this. But you can know in advance whether a stock has the potential to move, and that movement can be up or down. And once you know that, once you have this one number and you can identify which direction the stock is likely to move, you can then take action on that. Now, I'm also going to share with you some very simple trading rules that we use with this one number so that you have a way to profit from them. Once you have identified a stock and you know the one number and you know which direction you think it's going to go, you'll also have a little mini plan for how to take advantage of those stocks. And what I'm going to teach you is how to calculate that one number. I'll give you a link a little bit later on for getting a simple set of screening tactics. I'm sure most of you are quite adept at screening for your own stocks, or you have your own stock lists, so to speak. And then I'll also show you how you can get your hands on our specific set of rules to profit from those stocks as we go through this training today. But that one number is what we call the PE gap. It can be used for both short-term trading and longer-term investing. And the idea behind it, the reason it can help you is it identifies trades that have the potential in a short-term time frame, which are typically 30 to 90 days, of generating 20% or higher returns. We've seen over medium term, which is really 3 to 6 months, that those gains can be up to 40% or higher. And for long-term trades, typically 1 to 2 years, we've seen this number return gains of 100% or higher. And I'll show you a couple of examples as we go through the rest of this presentation in just a few minutes. But I do want to point out that this number that I am teaching you today is not specifically geared or designed for day trading. It's a strategy that takes advantage of changes in a stock's price so that you can sort of capture the momentum of a rapid move. Sometimes that move is up, sometimes that move is down, but consistently be able to capture and compound returns from those stocks. Put simply, the basic definition of the PE gap is it's the difference between a stock's price-to-earnings ratio and its expected earnings growth rate. Now, if you're not familiar with those two concepts, price-to-earnings ratio and earnings growth rate, don't worry, I'm going to teach them to you here in just a minute. If you are, you'll have a pretty good idea of where I'm going with this already. When I show you how to calculate this number, the key thing to keep in mind is that the wider the gap between those two numbers, between the PE ratio and the earnings growth rate, the better the opportunity is for gains. And again, you'll see an example of that in a second. And as I said, you can easily do this with simple subtraction and division. And it really, we've narrowed this down to be very simple for anybody to use it, and it's a very safe and viable way to boost your portfolio in any of those time frames. Again, short, medium, or long term. Now, the beauty of this one number lies in its simplicity. It allows you to own stocks that have strong profit growth expectations, yet are currently trading for a low valuation. This is what we call buying value at a discount. We all want discounted prices, right? We all want to buy stocks on sale. This one number will help you identify the stocks that are on the biggest sale. Every quarter now, obviously, you know, earnings are released. So there is a way for you to constantly or consistently measure the changes in this one number, the PE gap. And as that gap closes sometimes, often dramatically, it gives you the opportunity to jump in, jump out, make decisions very simply without sort of overthinking or overanalyzing any of the stocks that you may be holding. And you'll discover that this is a reliable fundamental analysis tactic to grow your portfolio, because you'll be able to capture consistent and really realistic gains. I don't think, when I say that the 20% in a 3-month time frame, I don't believe that that's not realistic. Actually, it's probable, and we see it frequently. And even when you're holding a stock for several months, 40% gains, they're certainly realistic, as are stocks that will double in price, sometimes in 1 to 2 year time frames. Now, as I said, there are two components to the PE gap. The first is the PE ratio, the second, the earnings growth rate. I want to dive into a little bit around the PE ratio and sort of explain to you why the way that PE ratios right now are not helpful to most investors, and then how we can change that. And the way that they're typically used, PE ratios are a quick way to assess a stock's valuation against the overall market, against that company's peers, and against its competitors. Typically, or historically, a PE ratio of 16 is considered a fairly valued company. That, if you were looking at the S&P 500. Now, obviously, you'll get companies out there that have outrageous stock prices compared to their actual earnings, and so you get very unusual PE ratios. Sometimes very, very large PE ratios. It doesn't necessarily mean that the company is overvalued. It simply means that the asking price for the stock is significantly higher than its actual price to earnings growth ratio. But the problem with PE ratios, as we look at it, is that it's always a rear view mirror number. If you go to any typical portal for financial information, whether it's Yahoo, Google, MSN, what have you, the PE ratios that they always show you are based on what the company earned in the last 12 months. So it's what's called TTM, or trailing 12 months, and that's why I call it a rear view mirror number. What it isn't is it's not based on what the company will earn in the next 12 months. And that is a critical point, and that is something you want to understand, because the way that most people use PE ratios is by using them as a backward-looking metric when Wall Street is pricing stocks forward. That's how stocks move. You know, PE ratios, as they're used right now, are great for telling you today's valuation, but you, as an investor or as a trader, are not buying today's valuation. You're buying the future value of the company. And the solution here then is, with the PE gap formula, as you'll discover here, it uses a forward-looking PE ratio to tell you the future value of the company's price based on that earnings growth. And that then tells you whether you have the opportunity to buy growth at a discounted price. The second component is the earnings growth rate. And as soon as I finish this next section, I'm going to show you how to calculate this one number and take you into some trade examples so you can see exactly how this is executed. But the earnings growth rate is how Wall Street prices a stock. It's based on what the street expects tomorrow's value of the company to be, based on the earnings that they will create for themselves. Now, the earnings growth rate tells you whether a company is expected to achieve fast growth in profits. It can also tell you if a company is going to achieve no growth or slow growth. These are important points, because slow growth or no growth are typically your defensive stocks, your cyclicals, your consumer stocks, companies that they don't have rapid growth prospects. So you'll often find that their earnings growth rates are very, very small. Tech companies, on the other hand, are your momentum stocks, biotechs, semiconductors, stocks that can have or can see a rapid rise in the growth of their earnings from one year to the next, or even from one quarter to the next. The fastest rising prices for stocks will come from companies with high growth expectations. So what the PE gap formula will do is to simplify the earnings growth rate to an instantly understandable number. And the higher that growth rate, the faster the price of the stock can appreciate. So when you put these two pieces together, you understand, and you already know, earnings are a known event. They happen 4 times a year. So once you learn how to calculate this number, there is is a simple way for you to, this is a simple way for you to keep up with the growth of the company. So as a company reports one quarter, you can continue to look out a full year ahead for their valuation of the company and the earnings growth of the company, and continue to assess whether this is still a stock you want to buy, continue to hold. Now that quarterly reporting will allow you to sort of stay ahead of Wall Street's valuation or their pricing of stocks in the marketplace. And it allows you to instantly update the outlook for the company that you're already invested in, as I just explained. Now, as we said, the two components here, when you put it all together, this forward-looking PE gap then will tell you if that company is undervalued today relative to its earnings of tomorrow. And tomorrow isn't just next quarter. Tomorrow is the next 4 quarters. When you use this effectively, it then becomes a predictive fundamental analysis tool that you can use over and over again. And one of the discoveries that we made, and I'm going to show you a chart on the next slide that illustrates this, is it's what we call the escalator move. These are the best stocks to own, and really you can find these types of stocks any time of the year. There's nothing cyclical about it. There's nothing special about it. But what the PE gap will help you find are stocks that are about to begin what we call this escalator move. And that move is a long move higher, can also be a long move lower, of a stock or on a stock chart, typically with returns that you'll see go from 20 to 25 to 40 to 100%. So that's why I say when you learn to use this one number, you can put together, or you can find stocks that potential in short-term, medium-term, or long-term time frames to achieve those individual profit objectives. So here's an example. This is Delta Airlines. I'll circle back on Delta here in just a few slides and show you what the actual one number was that accompanies this chart, and you'll see how that gave us this this opportunity. But this is Delta Airlines. The chart time frame here is 2013, the full year. Now, anybody looking up Delta will know that the stock continued to run substantially in 2014, especially after being added to the S&P 500. But what you see here, I've marked out an entry point right around the beginning of 2013, and you can see the 4 boxes there. There was a 20% point, there was a 40% point, there was a 100% point. This is an escalator move. This, and you can see a relatively quiet chart. There's a little bit of volatility in a few spots. Some of those occurred when the markets were down or were going down, and obviously Delta continued to rise. It was in a very strong bullish channel. It stayed in that bullish channel. But you can see these little points. Once a stock starts this escalator move, it has this potential to go from entry to 20% to 40 up to 100%. Now, not all stocks are going to get to 100%. Again, the key point here, and you'll see this in some numbers in a minute, is the bigger this gap between the price to earnings ratio and the earnings growth rate is what tips you off to the longer term potential for growth of that stock price. So this is the actual calculation, and once I get finished with this, I'm going to actually walk you through some examples and show you how simple this is. Remember, you can do this in 60 seconds. You can do this in your pajamas at home. It isn't hard, and eventually you'll actually be able to do this without a calculator. But the price to earnings, the PE gap calculation is very simple. It's the price to earnings ratio minus the earnings growth rate equals the PE gap. That's the number you're after. That's the number that tells you whether a stock is discounted relative to the future valuation of the company. So let's we'll do some examples here in just a second, but some basic rules of the road, and these are very simple to follow. And it does defy a little bit of logic, so follow along with me here if you would please. But if the PE gap is negative, it means that the company is undervalued relative to its future earnings growth. That's a stock you want to buy. If the PE gap is positive, it means the company is overvalued relative to its earnings growth rate. That's a stock that you may want to sell or simply not buy. If the PE gap is 0 or giving a little bit of tolerance, +1 or -1, it means the company is fairly valued for its future growth expectations. And if you're holding that, so if you own that stock, it may simply be a stock to hold for the time being. You probably won't see significant growth in the price, but it doesn't necessarily mean it's a stock that you need to bail out on. remember that PE ratios, because of price changes and earnings estimates on companies, are frequently changing. What this creates is, where it creates opportunity for you as an investor or as a trader, is we have this inefficient marketplace now, which frequently misprices stocks. And in many cases, those mispriced stocks are because Wall Street doesn't even understand the company or what the company does or how the company makes money. And the PE gap then will help you to identify these mispriced stocks and then be able to take advantage of them. This is the one formula that is the common denominator in our trading program called the Millionaire Blueprint program, but I'm teaching you just how to calculate this number here today. But that's the number that we've been using to identify trades for the last 2 years and to take gains of 20, 40, and sometimes 100% in our program. So again, just a little bit of definition and some ground rules, and then we'll walk through some examples here. Remember that the gap is occurring between the price-to-earnings ratio and the earnings growth rate. When the price-to-earnings ratio is greater than the growth rate, that's creating an overvalued stock. When the price-to-earnings ratio is less than the earnings growth rate, that's creating an undervalued stock. And the wider that gap is, the better that opportunity is. Because what we see is that these PE gaps will trigger gains of 15 to 30% returns in short to medium term time frames and higher returns in longer investment time frames, just like the Delta chart that I showed you, which within a year had a 100% return. And actually, if you future casted that out another year to 2014, the overall gain for Delta was over 300%. So here's an example. This was actually a recommendation, so I'm using kind of a live trade from our program to show you how this works. And then we're going to dive into the actual calculation and the numbers that you need. But this was a company called Manitowoc. The stock symbol is MTW. In our program, we made this recommendation back in December of 2013. And at the time, the price-to-earnings ratio for the company was 16. Its earnings growth rate was 19. You subtract those two numbers, you subtract the earnings growth rate from the PE ratio, and that gives you a PE gap of -3. Now remember, I said when the PE, it's a company that is undervalued relative to future growth expectations. And you can see on the chart here, we made this recommendation again at the beginning of December of 2013, and within about 35 days, that stock had reached a 20% gain. And it did continue on for almost a 50% gain in just over 60 days. So again, here's the start of that escalator move. Now, Manitowoc didn't finish the escalator. It got up to 50 before it pulled back substantially. Here, there were 2 profit opportunities for you if you had found this stock, calculated the PE gap, used it as an entry, as a time to buy the stock. Giving you. So again, you want to buy the stock when the PE gap is negative than the price-to-earnings ratio. And you want to avoid the stock or potentially short the stock when the PE gap is positive. The wider the numbers you need, and this is why you'll be able to do this in, and I say 2 minutes or less, I think you can do it in 60 seconds or less. Current stock price, you need the earnings estimate of the current year, fiscal year. You can get these numbers on Yahoo Finance. It's the easiest place to get them. That's where we get all of our data from. If you're on Yahoo, you simply go to the stock symbol that you're looking for, and in the left-hand tab, you're looking for analyst estimates, which is about 3/4 of the way down, the options in there. And once you click on that link, that brings you to a screen that looks just like this. So here we're looking at American Airlines. This is actually a stock that we recommended late last year in October. So here we have our 3 numbers. $51.40 at the time was the current stock price. And you can see the earnings estimates blocked out in red box there for you. This was for the current year, December 14, and then the next year, December of 2015. Once we have those 3 numbers, we do 2 simple calculations, and we'll have our PE gaps. So the first step is to calculate the price-to-earnings ratio. That's done by dividing the current price by the current year's earnings estimate. So in our American Airlines example here, it's $51.40 divided by $5.72, which equals 9. That's our PE ratio. It's a PE of 9. Next, we calculate the earnings growth rate of our next year earnings divided by the current year earnings. So we're looking for the nominal number, the percentage growth of next year's earnings over this year's earnings. So in this example, that was $8.42 divided by $5.72, which gave us a 1.47 return. You subtract the 1 to get the percentage, which would be 47 or 47%. We now have the two numbers to calculate the PE gap. So again, it's the PE ratio minus that earnings growth rate equals the PE gap. So we had a PE ratio of 9, an earnings growth rate of 47. We subtract those two numbers, and we get a negative 38. That's our PE gap. So again, minus 38, we have a negative PE gap. It tells us the company is undervalued. We want to buy this stock at current prices. Now here's an example of the actual result. When we made that recommendation, the stock was trading at $34.50. You can see that on October 1 of 2014. By the end of October of 2014, we had a 20% gain in hand, and then by November 28th, again, within 60 days, we had a 40% gain. So again, you see this rapid rise. Some folks may be a little concerned about the six red bars there right at the beginning of October, but I'll remind everybody that to keep in mind rather that at the beginning of October of last year, and this was true of every airline, if you'll remember the CNN 24-hour Ebola news, that's partly what you're seeing there, as well as the overall markets were starting to roll over at the beginning of the month of October. But you can see how quickly this stock not only rebounded just to break even, but continued right on for a substantial gain. And actually this was a great example, too, of the oil airline trade, which is taking place in the markets and has been for the last several months. Oil down, airlines up, oil up, airlines down. You can kind of like play with that one on your own. That's a little freebie. But all of the airlines actually went through almost exactly the same kind of chart. You can see this on UAL, on Southwest, on LOVE, LUV. You can see it on Alaska Airlines, on Delta did the same thing. So this kind of pattern of finding that one number, identifying the company that's undervalued, and knowing how to then take advantage of that company, that's the power you'll have in your hands here in just a few moments. So, and again, you can do this at home. I mean, this is not hard to do. So let's take a look at another example. This is Meritor. If you don't know Meritor, stock symbol is MTOR. They are an automotive company. They're a tier 1 automotive supplier based out of Michigan, my hometown, so I know them well. At the time that we were working with this stock, it was at the beginning of November of last year. The company had a PE ratio of 15, an earnings growth rate of 35. That gave us a negative 20 PE gap. So again, the PE gap is negative. It's a buying opportunity. And you can see I put the numbers here on the screen for you. The current price at the time we made the recommendation was $11.49. The estimate 75 cents and $1.01. So you can see obviously right away the earnings were expected to grow by a fair number. That gave you that 20 or 35% growth rate in 1 year over the other, so that gave us our negative 20 PE gap. And here's an example of how that trade worked. Within really 12 days, that stock had moved up and hit a 20% target. You can see, again, the beginning of that escalator move. The stock had run up until just about a month ago when they reported earnings that missed expectations. And the stock took a little bit of a fairly good haircut in 1 day. But you can see that this stock continued all the way up to a little over a 30% gain in just over 2 months. So it doesn't take much. That's how powerful this number can be for you. Sorry, I have a repeat slide there. So again, remember that when the PE gap is negative, that's a tip for you to buy the stock. When it's positive, that's a time you either want to avoid or potentially sell the stock. And again, as I've shown you on some of the charts, you can use this in short-term time frames for 20% gains, for medium-term for 40% gains, and long-term up to 100% or higher, depending on how long you hold that stock. So I told you I would circle back on Delta Airlines. I want to keep that promise with you. This was the actual recommendation that we had made for Delta back at the end of 2012, heading into 2013. And I'll run through the numbers just again so you can see how rapidly the stock moved. The company had a PE ratio at that time of 6. It had a profit growth rate or earnings growth rate of 53, which gave us a negative 47 PE gap. Now again, that's a much bigger gap than you've seen on a couple of other examples, like the Manitowoc had a -3, but you saw that that stock still moved dramatically. Here's a -40, a -47, and this stock went up and doubled in value. So again, the PE gap result was negative, so it was a buying opportunity. The buy price at the beginning of 2013 was $11.87. When we were tracking this at the time, the gain was 141% as of November of 2013. Now, that's a historical example, but you still see the power of being able to buy that value at a substantially discounted price. So what I'm going to do now, hopefully this works. This is where I'm hoping my technical issues don't come up. And Reed, if you would, just take a quick second and let me know that Yahoo Finance is showing up on my screen over the top of my PowerPoint. Or if anybody would let me know, just drop a note in the question. All right. Hopefully everybody can see Yahoo Finance here, and we're looking at American Airlines. This is a stock that we still like even today. We've been holding it for a number of months, and I told you that to find the analyst estimates, and let me make this a little bit bigger for folks. You see analyst coverage and analyst estimates here down on the left sidebar. That's the link that you would click to get into the actual estimates. And here we see American Airlines is in an unusual circumstance here, and the reason is because of the price of oil. And that unusual circumstance now, so I'm sort of showing you the flip side of this PE gap calculation. That unusual example is that their 2016 earnings are now projected to be lower than their 2015 earnings. The reason? Price of oil. As the price of oil continues to go down, that's money that flows directly to the bottom line for the airlines, depending on how they've hedged their fuel costs. So here, without even having to do the calculations, you can see that American Airlines they're supposed to earn $10.35 for the year versus next year $8.76. So you automatically know, just by looking at those two numbers, that their earnings growth rate is going to be substantially lower from this year to next year, well, from next year backwards to this year. But even so, if we were just doing a basic calculation on this one, we would have $54.16, and we would divide that by the current year's earnings. So again, the current price of $54.16 and the current year's earnings of $10.35. When you divide that, you get a result of 5.23. That's the forward price to earnings ratio. So again, is this company undervalued based on that? For this current year, I would say absolutely. But for their earnings growth is obviously going to be a negative number because of the issues with oil. So in this case, this might be a stock where maybe it's a little not overvalued, but it's fairly valued until we get some more reality in the oil markets and see how that actually impacts companies going forward. But we'll take a look at another company. That's CMP. There's a company called Sucampo Pharmaceuticals. We'll do the same thing on this one real quickly. This is another stock that we've been working with. And here you can see sort of a smaller growth overall expectations. We have the current price of $17.74 divided by the current year's earnings of 63 cents. That gives us a price to earnings ratio of 28. And then we look at the growth rate. So we take 79 cents and divide it by 63 cents. That gives us 1.25. So this company is slightly positive. So this is a company that we would have a positive PE gap, a PE gap of +3. So this might be a company that we would either sell or simply avoid. So there are just a couple of other quick examples. Again, trying to help Reed keep on time here. I wanted to get through those briefly. I can talk more about them as if we do some questions here at the end. But once you've identified these stocks and you've found those that you want to buy because they have that negative PE gap, the other thing to do, or the next thing to do, is to monitor those trades. So you've bought it. Maybe you're running up to that 20% or running up to that 40%, and you need to know, what am I going to do next? So here are some basic rules that you can use. First is to always check the earnings reports for the companies that you're holding. Are they beating estimates? Are they missing estimates? Are they doing the 1 penny beat or just barely meeting estimates? All of those can be little triggers that there's something maybe not right going on with the company at that particular time. You also want to check for analysts' revisions over the last or the prior 30 to 90 days. A quick example of that, if we're looking here at Sucampo Pharmaceuticals. If you scroll down on the same analyst page, well, they don't have enough, but you can see that there have been some upward revisions in their earnings here over the last 30 days. So the expectations are rising for this company not only for the first year, for this year, but also for next year. And if we had gone back and did the same thing with American Airlines, you see some pretty interesting numbers on that one. Again, on the estimates. And if you look at the trends and the revisions, you can see that this company is, again, their earnings per share expectations are rising, not only for this year, but also for next year. And what you can see here is 90 days ago, the company was expected to earn $8.38 for the current year and $8.03 for the next year. But now it's $10.35 for the current year and $8.76 for the next year. So these are important points to simply check. All you want to see is, are the expectations rising? Because if they are, then what that's telling you is that there's still an ongoing opportunity for profit out of that company. If those numbers decrease in the future estimates, then that's telling you, hey, this company maybe it's time to step away. So again, if the stock is beating estimates or analyst estimates are rising, it's a good time to hold the trade. If the stock is meeting estimates, you may want to hold the trade until the PE gap is 0 or turns positive, because that will be a shift for the earnings growth expectations. And if the stock is missing estimates or if analyst estimates are decreasing, that's a time to close the trade. And then here's some standard ideas as far as when to sell a PE gap stock. First of all, always plan ahead. And what I mean by that is you want to set a target and or a trigger event. So for example, what we do in the Millionaire Blueprint program is that 20% is our first decision trigger. That's what we call that. It's a point at which we have to make a decision. And once we make that decision, it's either buy, hold, or sell. Buy in terms of we're buying the next layer. We want to go from 20% to 40%, or we're holding to see if we get a little bit more out of the particular trade, or we're selling it to take our gains, go home, and start over again with another stock. You can use trailing stops or hard targets in terms of the price, but just make sure you stick to them. I know that's the hardest thing for all of us to do as investors and traders, but the key with this, it works when you don't get substantially greedy. So if you get 4 or 5 stocks that are hitting that 20% target, take that 20% and roll it into something else, because you can do this again and again, month after month. And again, the biggest thing though is if you see that PE gap number change from a negative PE gap to a 0 or a positive, that's a warning sign. That's a sign or that's a time where you want to look at exiting that stock and moving on to another opportunity. Now, we are doing a simple special offer for everybody. I know that I've gone through this somewhat rapidly today, and although it's pretty easy, I think, to at least calculate, we've put together a simple but very complete PE gap training package for everybody. It includes everything that I'm about to explain to you. It's very simple to get through, and it's $7.95. So not a real barn burner in terms of the price here. But that's because this is a powerful little fundamental analysis tool that most people don't know about, and certainly don't use because they don't know about it. So we're really putting together a simple special price for everybody, because it's, what we want is for you to learn how to use this. And what we've put together for you is a 45-minute in-depth training video. So basically the simple steps that I've walked through, but we also include how to screen for stocks that work best with the PE gap methodology. We show you how to calculate the PE gap with even more examples. We show you how to build a PE gap watch list. So you may find stocks that maybe you can't take advantage of today, but you want to keep a list of 10 or 20 potential bullpen stocks that you can reach into whenever your funds allow and have an opportunity to still get those 20 or 40 or 100% gains. So we also have what we call our PE gap trading cheat sheet, which I'll walk you through here in just a moment, and a bonus Excel spreadsheet, which I'll show you in the next slide. And you also get all of the presentation slides that accompany the 45-minute training video. So the training video is very in-depth. We go a lot slower than I just did here, I promise you. But the key behind it is it teaches you how to find the stocks that you want to look for potential PE gap candidates, how to calculate it, how to take advantage of it, how to pick an entry point, and then how to profit from them. I think that's relatively complete. So the two bonus training materials that really are the most important, first is the PE Gap Excel workbook. It's a very simple spreadsheet to use. It automatically calculates the PE gap for you. So if you really don't want to spend the 60 seconds calculating the one number, you simply enter the data into the PE Gap Excel spreadsheet, and it calculates those PE gaps for you. So you can see these are some examples that I had run on Gilead Sciences, American Airlines, and Microsoft. Microsoft at the time was positive, Gilead was negative, and so was American Airlines. So this will give you a very simple way to find those opportunities. Remember that one thing that I did gloss over a little bit, and I'll kind of talk about it here in just a second. When you're looking for if you short stocks, or if you are if you're looking for opportunities to short stocks, you can use the positive PE gap for those prospects, but do understand that shorting stocks, the life expectancy of that trade tends to be much shorter and also tends to be much closer in or around an actual earnings event. That's when Wall Street will sort of vigorously or viciously reprice that stock substantially. Usually that's where you see the gap down moves of 10, 15, or 20% on those stocks. But that positive PE gap can tip you off to those potential companies, those companies that may run into that kind of a scenario. But you're not often going to find, we have not found anyway, the short end of the stocks running to minus 40 or minus, obviously not minus 100%. So just bear in mind that if you do short and you want to use the positive gap, there's slightly different, you have to take a slightly different time frame in mind, typically 30 to 90 days, and 20% is about your max gain typically. But the trading cheat sheet that we include, it gives you the types of results to look for. So for example, if you get a PE gap that's -1 to -5, the cheat sheet gives you the length of trade, so whether it's short, medium, or long term. It'll tell you the holding time, and it'll tell you what type of profit targets you should assign to those particular PE gaps. So again, everything that we could include to make it easier for you, to give you more power to choose from investments and opportunities. Again, that's the complete PE gap training. I'll give you the link here in just a second. 45-minute in-depth training video. It also includes some screening tactics that you can use that we find work best with these stocks. I'll show you how to calculate the gap again, how to build a watch list, how to use the cheat sheet, the Excel spreadsheet, and then all of the presentation slides. Everything's included for $7.95. I'm not trying to get rich. Fundamental tactics into your hands. So take advantage of this, please. Hopefully we'll get a chance to do this again with you folks, but the way to get it, very simple. You go to millionaire-blueprint.com/one, O-N-E. That will get you right to the reservation page to grab your copy of the full PE Gap training program. I'll stop there for a moment and see if we have any questions. I'm sure there should be a few here. But if you folks have any questions, I don't actually know where they are.
If you see on the little dashboard, there should be a little section that has a plus mark and then questions.
Yeah, they were. I'm trying to go by timestamp, so I had to resort them real quickly. So Al asks. Oh, by the way, Reed, how much time do I have here? About 5 minutes, okay?
You're looking at about 2 to 3 minutes left now.
Okay, I'll do these really quickly here. Al says, I gather the greater the negative number, it's a better buy, and the greater the positive, it's a better short. Yes, well, especially on the buying side, the larger that PE gap is negative, the longer the term the opportunity.
Hey, John, looks like we lost you there. Your screen's still coming up, but all we're getting is static on our end. I'm going to unmute you here in just 1 second and see if it's come back. Oh, looks like we're good. Hey, John, can you give me a quick sound check? Check, check, check. Okay, well, we might have lost John. I do see your screen. You are unmuted. Hey, John, can you hear me? Just 1 second here, ladies and gentlemen. I appreciate your patience. These things happen sometimes. A little technical difficulty. We did get his link out to the chat, so if you want to go and follow the www.millionaire-blueprint.com/1, that will take you to John's offer. Hey, John, I'm seeing your mouse move. Are you back? Still can't hear you.
Am I back now?
All right, there you go.
Yes, I lost my Wi-Fi. Sorry about that. But I'll just finish off a couple of the quick questions in here. Jacqueline, thank you very much. I'm glad to be able to help. David, how do you determine the EGR? David, you divide you divide next year's earnings estimate by the current year's earnings estimate. That gives you the earnings growth rate. You have to subtract the number. You have to subtract 1 from that number so that you get an actual percentage number. That's just a mathematical function. In the training, I show you again how to go in and do that quite simply rather. But again, let me just do a quick backup to. So just using this this slide right here, David, again, you would take the 2015 estimate and divide it by the 2014 estimate, then subtract 1, and that would give you 35 in this example here. When you do the PE evaluation to enter trade at the quarterly report or at any time, you can do this. You can use this. You should be using this on an ongoing basis to identify potential trades. The way that we do the Millionaire Blueprint program, we simply enter trades right at the beginning of the month, in part because we're not technical traders or market timers. So we're following sort of a very simple month-in, month-out kind of process. But when you identify a trade, you can use this to enter at any time. If you're a technical trader and you find a really sweet entry point and you have the fundamental backing for the rationale for why you want to own that particular stock, you put those two pieces together, I think you're in a very good position. But that's a great question there. Alan, thank you very much. And what is the phone number? You can call us, Jacqueline, I'll throw that answer live, but you can call us at 800-863-7650. That's our phone number, which is also on the order form. If you go to the link that I gave you, millionaire-blueprint.com/1. Let me try to get down to it real quick here.
Hey, John, looks like we have time for one more question here.
I don't think we do have any other questions. I think we're good, Reed. And I know you got to get caught back up. So I will say thank you very much to everybody. If you go to the millionaire-blueprint.com/1 link, the phone number is at the bottom of the order form so that you can call us for help as well. So Reed, thank you for hosting us. Thank you for having us online. And folks, everybody, thank you for your time and attention.